Are you tired of missing out on profitable opportunities due to hesitation and fear? And do you find yourself struggling to execute trades with confidence? Many fast learners like yourself do not actually have a problem learning a trading strategy from online resources. Yet, when transitioning to live trading, everything that you learned in theory starts to seem very uncertain. This is indeed a very frustrating and toxic cycle, but deep down, you have faith in yourself and the desire to make trading work. You know that something must be fixed. Fear not, because in this video, I want to help you dive into trading executions and overcome these deep fears that hold most beginner traders back. If you have seen my older videos, you know that I was a losing trader in my first 2 years of trading. I was just like every other trader who struggled with executing my entries and exits. I only started seeing my trading performance turn around after I fully understood the 3 key reasons why traders fail at trading executions. I'll be breaking down these 3 main reasons using real trading examples and provide you actionable tips to start improving your executions today. As always, I appreciate a gentle tap on the like button for this video down below. And now let's get started. The first key reason why most traders fail at execution is very practical. Most traders, especially beginners, do not have a set of clearly defined strategy criteria. Let's take a moment to reflect. What are your criteria to enter a trade per a specific strategy? If your answer is, I'm looking for a double bottom chart pattern, or I'm looking for the price to cross the EMA or reclaim VWAP, your entry criteria are overgeneralized. Okay, hear me out. Technical chart patterns and indicators are great for analyzing trends or short-term sentiment. But they should not be the only confirmation or the only criterion for your strategy. Our strategy setup criteria should include a checklist of fundamental and technical conditions depending on the markets you trade. For example, the most common criteria in my various strategies are market cap of the stock. Small caps, micro caps, and large cap stocks, they act very differently. News catalyst, whether it's bullish or bearish, as that may determine a bias on a play. Next is technical analysis. What does the chart technically tell you about the short-term direction? And many other factors, such as time frame horizon, sector hype, is the stock easy to borrow or hard to borrow? While trading is definitely not easy, it can be simplified to prevent overthinking, overanalysis, and of course, fear of execution. Your entry criteria are essentially a list of if and then statements. So if you see that A, B, C, and D are all present, then the result is likely going to lead to E. This logical thought process is very crucial if you want to fix your tendency of FOMO or fear of executions and be more prepared the next time you plan to take a trade. Now, to help you understand this if and then thought process, let me walk you through my own trading executions on a recent trade. You'll see how I use a defined set of criteria from trade planning pre-market to entering the trade and to exiting the trade. So the trade you see on screen is NVIDIA on the short side. Let me go through the executions, the trade planning, and the thoughts process behind it. So the reason NVIDIA was on my watch list in the beginning is because it always shows up on the new gap up scanner every single day. Since you can see the last couple of days here, it's been making new all-time highs. And that's the reason you always want to scan for stocks that are gapping up, because these are going to be the stocks that will give you the most range and volatility, whether you are trading on the short side or the long side. Now, the trade I traded in particular is this day on the short side. The previous day, it went to a new higher day at 870s. And the next day is where I executed the short. Now, big picture wise, the reason I thought there was a play on the short side for Nvidia is because these kind of stocks, they generally need to pull back first, consolidate at the daily support before heading up higher, especially for a stock like Nvidia that's been, on a tear for the last, 2 months. It's already been quite extended. And these kind of stocks that keep breaking out every single day, there's potentially 2 ways to play this. So pre-market on that particular day and the daily charts here, I see 2 potential plays. For the long trade to be triggered, the stock has to either break through the current day's pre-market highs level around the 866, 867s area, or it has to pull all the way back down to the daily support area at around, as you can see, 837. So either a break of 866 or, if it pulls all the way back down to 837, then that's the long play. Remember, the stock is very extended. It's been making new all-time highs every other day. So even though your long bias may be correct, you don't want to be chasing the breakouts. So that's the importance of planning for your long entries. Now let's talk about the short side. If the market pulls back, this Nvidia stock is very sensitive and can panic very easily whenever there's a sharp pullback on the overall market. That's what you saw on this particular day, in which it was making, trending up, making new all-time highs, and pulls back really sharply, essentially erasing 50% of the gains on that day. So on this particular day, if the stock is staying below that pre-market highs level, that key level we talked about earlier, and it goes green to red, at that day, at time, the previous day's closing price is 852.50s, so that's your red to green line. If it goes from green to red, that can trigger another set of panic. So you can see another sell-off like you saw on the previous day. So if you're planning for the short side on these kind of stocks, you want to make sure you have the key levels planned out as well as that trigger point, which for Nvidia was the prior day's close, 852.50s. So once it goes green to red, we can see the move down all the way to that daily support area around 837s. This is how key levels for each bias is clearly defined and planned out way before the market opens, and definitely before you enter a trade. By doing this process will help you with gaining a lot of confidence in executing the actual live trade. And as always, if you're enjoying videos like these, breaking down specifics of trading executions, don't forget to drop a like down below. The second reason why a lot of traders fail to execute a strategy is because they don't know the timing of their setup entries. There are 2 crucial concepts that you must know as a trader. When is your setup most likely going to appear during the day? And does your setup allow multiple entry timings in case you miss the initial entry? If we're using the same example on Nvidia, our previous trade, these kind of technical mean reversion trades usually happen within the first 2 hours of the market open for large cap stocks. That's the reason I want to make sure I'm sitting in front of the computer at least 30 minutes before market opens to observe the stock and the price action. But I've also noticed and understand that these kind of large cap stocks, they can actually chop around this prior day's close area or the green to red line for an extended amount of time before eventually going red. So you can see this is the 5-minute chart here. So that means the stock actually chopped around for a good half an hour before it actually went green to red on the day. But that's why I planned my entries around this area. As you can see on the chart over here, you can see that it's not exactly a precise entry, but rather than an area. So that's the importance of, dividing your entries up into little pieces so you can scale in as you are proven right. Remember, your entry should be an area, never a precise price. So for me, when I'm trading this particular stock, as long as technically the stock is showing that it's trading lower lows and trending on lower towards a previous day's closing price and going green to red and slowly trending below and breaking down, then the thesis is still valid. Then I can scale into the entry short 2 to 4 times usually and have the break below green to red as the final confirmation. So you can see on this chart here, a breakdown below that dotted line, that is the final confirmation in which I went and added back in. So again, knowing the entry timing and when your specific strategy or setup is likely to occur is very crucial. But for me, if I'm trading the strategy, then I need to observe the time that this kind of price action, the consolidation, trending below red to green line, that's actually happening within the first 2 hours of the day, not in the afternoon. Because different timing on the same set of price action could lead to very different results. Now moving on to the third reason why a lot of traders are struggling with execution is because once they enter the trade, they don't know how or when to get out. Earlier, we talked about the importance of planning for your entries and timing for a particular strategy. But what is equally important is to know how to close your trades. There's only 2 scenarios that can happen once you've entered a trade according to your criteria. You either close your trade for a profit or you close your trade for a loss. Now, whether your profit is big or small, and whether your loss is small or, unfortunately, way more devastating than you had expected, all these factors can definitely be controlled. That's why you must have an exit strategy. You need to know these 2 things. First, where is your take profit target? And second, where is your risk level? Essentially, where are you stopping out? Going back to our earlier trade example again on NVIDIA, we talked about if the stock goes from green to red, breaking below this 852.50's previous day's closing price, then I'll go short. And once I go short, then my ultimate price target is this 837, this daily support level over here from the previous day's low of the day. So that's the reason you can see on this execution chart that I covered all my positions into the 837 area. Like I started covering around the 841s, 838, and 837s. All of this price target is pre-planned. And that's the same as the risk area. If the stock broke through that pre-market high level around this 867, 866's area we talked about, then I will have to stop out for a planned loss. Going back to using the if and then statements we talked about earlier in the video, that concept applies for having an exit strategy as well. In trading, so many beginner traders stress about perfecting their entries and the timing. While yes, those things are very important, they often forget about timing their exits. As an example of this, I did not properly plan for my exit strategy and take profit on this trade on the short side as well, on PHUN, fun. Let me tell you, that trade wasn't very fun. As you can see on this chart, I missed out on at least $3 profit per share. That's thousands of profits. As traders, you know that if there's anything that hurts more than a big loss, it's leaving too much money on the table. Just like the old grandma's saying, practice makes perfect. Tomorrow when you are trading, remember to think of the following before you place a trade. 1. Do you have a clearly defined criteria for your strategy? Have you planned for your entries and your timing? Do you have a take profit target planned as well as a risk area? It is truly up to you to practice the 3 key takeaways from this video to improve your trading executions. You'll gradually master your emotions as you see the positive results of your hard work over time. I hope the actionable tips today help you become a better trader at executing the buy and sell buttons. And please don't forget to tap the like button down below if you'd like to learn more about the reality of trading. Like I mentioned many times before on this channel, most profitable traders I know, they reinvest profits from trading into other longer-term investments that will grow their wealth passively. This free tool is not only a portfolio management tool, but also a social platform that allows you to follow other traders, investors, and see their portfolio holdings. This tool is Blossom. Anyone can download Blossom for free and connect the app to your brokers safely. They do not share personal data. For example, you may have different holdings in Robinhood, Vanguard, or Webull. Well, you can now securely connect them all under one portfolio analytics platform. There's also a social feed for you to connect with other traders or investors who are following the same stocks. And you can even see their returns and what kind of trades they've made in the past. For example, on my profile, you can see all my investment holdings, how much I'm up or down on the year, as well as my recent buys or sells, all in percentages. So make sure to check out Blossom. It's free to use down below. I'm an angel investor in Blossom, so I would love to hear your feedback down below. You can also learn more about the technical analysis and price action strategies in my free crash course over here.